Good morning, everyone. My name is Tracy McKibben. I'm the chair of the Finance and Risk Committee of the Authority and the New York State Canal Corporation. I'd like to welcome my fellow committee members, Chairman of the Board of Trustees, John Canal, Dennis Traynor, Eugene Nicandri, Anthony Pacenti, Betheta Gonzalez. Michael Baboni is excused from the meeting this morning. I'd also like to welcome our NYPA and Canal Corporation staff who are attending with us today. This meeting has been duly noticed as required by the Open Meetings Law, and I call this meeting to order. Everyone's had a chance to review the agenda for today with one minor adjustments. And if there are any questions, do any members have any amendments that they'd like to propose for today's agenda?
Do we,
there being none, I'll ask for a motion.
don't we have to roll the canals? Don't we have to make a motion to move the canals approval into this, or is that covered somewhere?
Well, I assume that the meeting agenda was sent with the update. I don't know. Someone tell me if the updated agenda includes the canal discussion.
It does, Tracy.
Yes, it does.
Yeah, that's what I thought. So,
Okay.
so yeah.
So moved.
Second.
Moved and seconded. All in favor, say aye.
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 Any opposed? Motion carries. Thank you. We will now, the agenda is adopted. We'll now hold the rest of this meeting. The meeting will be held in executive session. I'll ask for a motion to conduct an executive session to discuss the financial and credit history of a particular corporation pursuant to Section 105 of the Public Officers Law.
So moved.
Second.
Moved and seconded. All in favor, say aye.
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 Any opposed? Motion carries. Thank you. We will be back shortly. I'll ask for a motion to resume the meeting in open session.
So moved.
So moved.
Moved and seconded. I think I heard a second in there. All in favor, say aye.
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 Any opposed? Motion carries. There were no votes taken during our executive session. We'll now move into the formal agenda. Members were polled prior to the meeting regarding conflicts and if everyone could mute if you're not talking. Thanks. Regarding conflicts and have submitted all potential conflicts to the corporate secretary for inclusion in the minutes. I'll now invite Adam Barsky, EVP and Chief Financial Officer, to present his CFO report. Adam, over to you.
Good morning, trustees, colleagues, and members of the public. Just giving an update on our 3-year actual and full year forecast. But before we do that, just to provide some context in terms of and follow up from some of the discussion at the last meeting in terms of where we were at the time we were setting the budget, making our forecasts, and where we are today and what's happened in the markets that's led to a good thing for us in terms of revenue and our meeting our plan. But because of the volatility in the market, the spike in energy prices, to give some context around that. If we go to the next slide, Carly. Yeah, just to give a sense here in terms of this is the average actuals and futures of the natural gas prices based on the Henry Hub. The orange dot is where we were at the time we were setting the budget. So 2 things are happening at that point. And we're using because we do have a lot of different energy prices, capacity prices, upstate, downstate. Our overall energy price is very highly correlated to the natural gas price. So to make it simpler for people to follow, we use this as sort of a proxy to explain what's been going on in the markets. But if you look on the chart, the orange dot represents where we were at the time we were setting forecasts for the budget. And at that time, the merchant gross margin was looking at $266 million. At that time, the natural gas price was below 450, but we're also was being forecast at that time a warmer than normal winter, which was built into the curves, which had the curves showing that prices would actually go down towards the beginning of the year and then starting to go up somewhat. If you look now towards the green dot, the green dot is where we are today. And based on the current model and taking into account the impact of our hedging program, which attempts to manage our volatility and lower our downside risk, obviously at a cost of some participation in the upside, but not all, shows where we are today, much higher, and that gross margin model projection right now is approximately $300 million towards the end of the year. So that's a significant increase from where we were when we set the budget, and that's sort of underlying the numbers we're seeing showing up in actual and in terms of our energy prices and what we're getting from the merchant book. On a historical perspective, if we go to the next chart, you can see where we were going back, say, 2011, and how high the natural gas prices were at that point in time. And then if you look from starting in basically 2017 through 21, we're in that very, very low energy price environment, which we said was a risk in terms of being prolonged there for a very long time. And then you can see as we went through 21, towards the end of 21, and as I mentioned before, where we were looking at the chart before, and you can see the spike as to where we are now. So this is what I would call almost like a 3 or 4 sigma type event in terms of the movement here. So it has had a significant impact on energy prices in general throughout the region, but certainly, in its impact on NYPA and, in a positive way for the time being. But the question really will remain in terms of whether or not this is a sustained price environment or not, or just a blip that will resolve itself over some period of time. To the extent it is a sustained higher price environment, as we mentioned before in our hedging strategy, we hedge out up to 65% in the year that's coming up. So by the end of 21, we were looking at being 65% hedged into 22. And then we have smaller amounts of hedging going on into the next year and the next year after that, and building up over time. So it's a rolling hedging program. So what that means is that if these energy prices are sustained at a higher level, we will gradually roll into those higher prices. If it's a blip, then we'll be protected from the downside in the current environment to the extent that have already been hedged. So I just want to give this some context as we look in terms of where we've been and where we are today. Next slide.
Adam,
We
before you
reviewed
go,
last time. Sure.
can you tell me what the length of the Russian-Ukraine war will have on the long-term gas prices? My understanding is the United States is going to try and replace Russian gas with gas from North America in some form or another as a long-term goal. Is that all factored in here?
I don't think any of the plans that are being discussed in terms of those alternatives that are going to be looked into is factored in today. But certainly that price jump that you see on that chart is reflecting the Ukraine-Russian conflict that's going on right now, which has caused that huge spike. I think until there's a plan and there's a sense as towards both supplies being available and how long we think that this is going to go on for, that will start to reflect into the market price as well. But right now you're seeing sort of the immediate shock of the events. And I think as more information comes in, the market will start to price that in accordingly. Because as you know, one of the reasons that prices were where they were for such a long time is because there was such an oversupply of gas. But given this conflict, and supply chain in general, all of that has sort of been exasperated. So you have really two issues. We had the supply chain aspect going on in general, and then we throw into it the Russian-Ukraine conflict, and the combination of the two has resulted in this exasperation of the price in the current market. So as more information becomes available, it'll begin to get priced into those forward curves.
So Adam, if I could, just another way of asking the question that Trustee Nicandri was asking is, obviously you're looking at, we've got a hedging strategy that you've put in place. And as you say, it gets adjusted on a regular basis. From your perspective, is it the belief that we will be in, however far out you go, whether it's, over the next year or next 3 months or 6 months, you think we will be in this heightened natural gas price environment for about how long as you've looked out, and as you continue to adjust your the hedging strategy that we've put in place to protect ourselves? How far out do you go in terms of your thinking of this elevated, looking at where the previous slide that you have, where we are now, how far out do you see this elevated pricing being? And that you're prepared, you're operating and making assumptions and adjustments according to.
Right. So in conversation with the ERM, and they can come back and talk a little bit more about some of the strategies that they're employing, but to the extent that we're seeing in the futures markets prices today that are above what we had as our targets in the financial plan, they're taking advantage of that and hedging out, 2 years out, 3 years out, to capture some of this price, heightened price that we see today. So this way that we are well positioned, if it normalizes, it backs off, we've locked in some higher prices. But we really don't, in terms of, telling you how long we think this is going to last, we don't have a crystal ball for. My guess is this isn't going to get resolved anytime soon, but to the extent that there's energy security policy involved, and there's what are the European nations going to do if they begin to get cut off from supplies? There's a lot of sort of what ifs here, and so the point is that we are in a very volatile environment, right? So the one thing that is clear in the modeling and in the forecasting is that the level of volatility that we were observing in the fall, let's say, has completely risen significantly over, since the beginning of the year, and certainly since the beginning of the conflict. So we are in a heightened state of volatility, and we're seeing it not just with natural gas, commodity prices in general have all been, spiking and showing that sort of volatility as a result of what's happening around the globe, whether it be COVID related in Asia and shutdowns, supply chain issues, and then again, the conflict adding to that. I don't know, Sarah, did you want to add more into that in terms of ERM strategy? I thought she's on the team.
No, not really. Again, you had the slowdown with COVID, and then, turning on the wells again. Clearly there's more, if there's reduction in gas to Europe from Russia, Ukraine, that, pushes up the price of liquefied natural gas, and so there's more of an incentive for the suppliers to ship it out of the country versus in the country. I think the most important thing to highlight is, one, we will have adequate gas, so we do not have to worry about that in terms of our interconnections and where we have it to support running our assets. And secondly, as Adam said, we have a hedging strategy in place that is meant to reduce the volatility ultimately, and ensure that we have a strong and clarity around our supporting our financial obligations and plan. So we can come back and talk to you in more detail about some of the macroeconomics. Clearly with China and the COVID lockdown, there's also concerns there relative to fuel usage and supply chain. So again, we're monitoring it on a daily basis. And the good thing about, gas for us is that we're purchasing it in the day ahead market and bidding the spark spread. So, we're covering our costs when it comes to any time we generate from those assets. And then we also have contracts on our gas assets, which are long-term contracts with fixed prices to cover the fixed costs of those. So again, the marginal cost gets covered in the bidding on a daily basis. So we don't anticipate seeing, significant downside on that.
Thank you.
So again, back to the current year, as we discussed, we're showing 65 million of real net income for the first quarter, driven by mostly those higher energy prices and offset by some additional expenses, namely being the monetized funds. So when we talk about impacts to customers, there is actually a positive impact to some of our customers in the sense that if we get more money out of our merchant sales above a tariff rate, that money gets put into an account in a fund for the benefit of those economic development customers. So they're actually seeing some benefit from these higher prices. Some of those that are not, perhaps the senior customers that are buying some of their power on the open market, they're seeing a higher price, and for us, it's a pass through, but they're seeing some higher prices as a result of that. But we're actually in the process of renegotiating some of those agreements with them to give them some more fixed price certainty over the next few years. So we're working with them on a plan that can help provide them more stability as well. But from the customer aspect, it's actually, there's some good news here for those customers. Next slide, please. And again, just the out year forecast, because the model has been updated, shown from 266 to 300 million for the merchant. It's driving those revenues higher, and our expected case right as of today is 77 million with a high case of 100 million, and we see that continue to move higher as we go and start realizing other revenues and get more clarity around this year. Other things that would go against it, as we've mentioned a little bit about, is an allocation of capital in terms of timing of spending our capital dollars. Some of that's a timing issue, but that could be a negative against the results, as well as unrealized losses on our investment portfolio, and the impact on the market's underperformance on our pension contribution this year could also be negatives against the positives that we're seeing in the energy prices. But overall, we see ourselves exceeding plans significantly this year. We're in the process of looking at our annual transmission revenue requirement, which that year starts on a July 1 basis, and we'll have an update for you at the next meeting on where those are coming in. My sense is that those will be higher as well, so we'll see additional revenues from our transmission revenue requirements based on all the work and efforts and things that we have going on in the transmission area. So that number will probably be higher than we're reflecting here today, but we'll have clarity on that by the next time we meet. Any other questions on the forecast? And then just an update on other things. The state budget came out. State's in very good financial shape. That's very good for us, because when they're not, that's always a risk. And as well as they're providing us some significant funding around our energy efficiency program by buying out a significant portion of our loan portfolio. So we receive that through the state budget. So that's a positive for us going forward. And balance sheet wise, our liquidity remains very robust and the balance sheet is strong. So other than that, if there's any other questions, we'll move on to the next item, which is the release of the Canal
Anything to add on
funds.
the execution on the green bonds, Adam? Anything to offer in hindsight?
Yeah, so just,
Editorial or great execution and
yes, thank you for bringing that up, Chairman. Yeah, so as you know, we did close on the 21st, the $608 million of, there were 100% green bonds to finance separately as a separately financed project, not using the NIPA credit for our two priority projects to date, Central East Energy Connect and Smartpath. And the sale went very well. We are, as you know, in a rising rate environment, and rates were moving consistently higher. What we benefited from was we had decided, given what was going on in the market and starting to see actually the attractiveness of tax-exempt bonds to individual investors, we decided to do a retail order period, and we achieved significant success with that ahead of the institutional pricing. So we created, what I would call scarcity on scarcity, and we were able to have our overall deal not only oversubscribed 3 times, but we were able to sell 50% of the bonds to retail investors, which again helped us with the pricing with institutional investors. And just to give some context, the overall rate we received was a historical low rate for NIPA. It was 3.62% for overall bonds that are going out to 40 years. Actually 1 basis point better than we did in 2020 with the NIPA bonds. But just to give some other context, this bond, because it was separately financed and it had its own credit, was essentially a AA minus, A plus, AA across the 3 rating agencies. So I would say AA category, more like AA minus. The pricing we received on the 5th was actually priced through a AAA rated New York issuance from New York City for their transitional finance authority bonds. So it actually priced better than a AAA New York paper. And again, it has to do with scarcity. It has to do with the fact that a lot of big funds that are filled up on certain big names and something they see high quality that's new and different. There was a significant demand from investors to have that in their portfolio as further diversification, and not to mention the fact that it was green, and they like to show that they have a certain amount of their investments in their portfolio going towards green bond allocation. And that continues to, we see continued momentum in that area in terms of investors not only wanting green, but also wanting to understand where are you in ESG. And we'll talk a little bit about that later with Kerry Jane. But that's become a very big issue with investors, is wanting to know, where do you stand on your ESG profile and your ESG policies, reporting, and values. So we can talk more about that, but thank you for bringing that up, Mr. Chairman.
yeah, well done. Great work.
That's really great work throughout the whole entire team. I mean, legal, we have our project management people here, Trish Labardi and her group. It really did a great job helping us put all this together. The next item is the release of the Canals third quarter. And it seems to be early to be doing that, but given the fact that we're not meeting until July again next, we want to make sure that we're compliant with our bond requirements and that we have the release happen ahead of any spending on third quarter Canals money. So this is the just the quarterly amount that's we've done every quarter according to the budget.
And Adam, we talked about this, and to your point, this is just our quarterly release, but we're obviously continuing to try to best optimize the Canal asset that we have. And this budget, even though it is customary and it's just our regular process, you feel like this will continue to help us improve that asset, mitigate any risk around that asset? Are we comfortable that this is continuing to help us do that, but also with an eye toward how do we continue to optimize the value of that asset to the organization as a whole?
Yes, absolutely, Chairwoman. this will help us start to reposition, the canals so that it can be used for a lot of the recreational purposes that we've set forth in the Reimagine, as well as providing critical infrastructure and resilience and hardening around those assets to avoid, as a risk management measure, and as well as just overall state of good repair and better management of that asset. So balancing those two things, and sometimes they go hand in hand, trying to not only provide that resilience and those hardening, but at the same time, allowing those parts of the canals to be open for recreational uses and, invigorate the area for the community's use. So those are the two sort of balancing objectives there. And this will help us there, but we've been doing a more deep dive into, what some of the future needs are from a resilience standpoint. And we will be coming back to you with more detailed information regarding what we think are going to be some of the future needs to do, as you said, optimize the asset and put us in a position to be able to maintain and harden for resilience purposes. So we will continue to update you on that by the time we come back in July.
Great, thank you. Any other questions for Adam on this release?
Yeah, I would merely ask that the authorization, since we're this far ahead of it, just be caveated with, some assumption that there's no significant variance from, our operating plan, whatever. So we won't have the benefit of real-time info. Just want to ensure we're not out in front of it with a blanket endorsement without ensuring operating results and outcomes continue to be what we reasonably anticipate.
Yes, and that will be part of that July update we'll be providing you.
Great. So if there are no other questions, and I failed to mention, there were no votes needed on Adam's CFO report. It was just an update. But we do need a motion on the release of these funds. And so if there are no other questions, I'd like to, if I could get a motion to recommend this item to the full board for adoption.
So moved.
Second.
Moved and seconded. All in favor, say aye.
Aye.
Any opposed?
And my eye is contingent on ensuring operations continue as anticipated. Okay.
Absolutely.
That's all.
Understood. Great.
Okay.
Motion carries. Thank you. Thank you, Adam. We'll quickly move to invite, great. Andy Boulais, VP Project and Construction Management, to present the next two items on our agenda under utility operations. Andy?
Good morning, thank you. I'm here to present two items for operations, the first of which is a contract award for transmission line construction on the Smartpath project. Today, we are requesting the Finance and Risk Committee approval of a 6-year contract award, recommend approval of 6-year contract award to Michaels Power of Neenah, Wisconsin, for the amount of $276 million to the Board of Trustees. This contract will support the execution of the Smartpath Connect project. As you may recall, was approved by the New York Public Service Commission in October of 2020 as a priority transmission project and subsequently approved by the trustees in March of 2021. The scope of the contract includes site and foundation work, setting of new structures, demolition of existing structures within the rights of way. Construction is anticipated to begin in June of this year, and a targeted in-service date for the overall project at the end of 2025. In November, a request for proposal was issued. 9 proposals were received in February. Following an extensive evaluation process on the criteria on the slide, the committee recommends a contract award to Michaels in the amount of $276 million for a 6-year term. Michaels' best value proposal was approximately $270 million, and we are requesting an additional $6 million to allow for flexibility for known risks and potential changes to permit requirements from the New York State PSC Article 7 application and the first of several environmental management and construction plans, which are expected to be approved in July and August, respectively. Thank you. I'll now take any questions.
So I want to make sure I understand, when you said that I'll call it reserve, the extra, that's included in the 276 total number, right? Or is there some
Correct.
additional? Okay.
Andy,
Any
there's,
questions? Sorry,
Andy,
go.
there's two parts to this. One is Haverstock to Adirondack. That's making the connection to take power north-south if need be. And then the Moses, Haverstock, Willis, Ryan is east-west. So they'd all be interconnected by a new substation. Is that correct?
That is correct. That new substation is outside of the existing substation or main switchyard of the Robert Moses Power Project, and is going to be called Haverstock Substation. From there, you'll have the east-west corridor and then also the north-south corridor.
Good.
Great. Thank you. Any other questions for Andy on this one? All right, no other questions. I'll ask for a motion to recommend this item to the full board for adoption.
So moved.
Second.
Moved and seconded. All in favor, say aye.
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 Any opposed? Motion carries. Okay, the next item, Andy.
The next item is a on-call contract award for control enclosures and relay panels. Next slide, please. Today, we are requesting the Finance and Risk Committee recommend approval of a 10-year equipment on-call contract to Wunderlich Malick Services of Eden Prairie, Minnesota, in the amount of $36 million to the Board of Trustees. Further, in accordance with the authority's procurement guidelines, we are requesting the committee approve an interim award ahead of the May board meeting in the amount of $1.5 million to maintain the Smartpath Connect project schedule. The services under this contract will support the authority as it advances Vision 2030. Services include engineering, design, furnishing of control enclosures and relay panels. They'll be used where needed to replace existing assets or when executing new construction projects such as Smartpath Connect. A request for qualifications was issued in June of last year, followed by a request for proposal. 4 proposals were received in January of this year and evaluated based on the criteria on the slide. Following an extensive evaluation process based on the criteria, the committee recommends an on-call contract award to Wunderlich Malick in the amount of $36 million for a term of 10 years. Thank you. I'll now take any questions.
Any questions for Andy on this contract? If no questions, I'll ask for a motion to approve it and to send it to the full board for adoption.
So moved.
Second.
Moved and seconded. All in favor, say aye.
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 Any opposed? Motion carries. Thank you, Andy. We'll move to the next item on the agenda. And this is a IT contract. And we'll turn it over to Lisa Beaty.
Thank you. Good morning, everyone. So this request is for what we call our IT co-sourcing value contract. As a reminder, this is our main consulting contract, value contracts that we use to support our variable staffing model. We use that because we never get enough employees for our peak demand. We want to supplement it with contingent workers, consultants, and other discretionary spend across New York State that we use. So this particular request is to extend it by 12 million and to go to June 30th, 2023. And the main reason for this, because we were here last year about this time, was that as we were preparing to replace these contracts for this year, we were asked by the cross-functional team that was addressing some of our third-party audit observations to extend so that they had more time to put an enhanced policy in place and a governance program and procedures so that we could very much align our new proposals, our new requests for consulting services with their future needs. So this is simply to extend and have that time so that we can align with them and move forward as we have been meeting the demand that we have across NYPA. So any questions at this point?
One just minor question I had was the original contract was for how long? I know it was supposed to end this year.
5
Right.
years. It was
Okay.
to end, yeah, it was to end in 2022, and we've been asked to extend it into 2023.
So presumably five years at 55, we're now a 6-month extension is going to cost us an additional $12 million.
12 million based on run rate and continued demand, yes.
I was trying to do that math as well. So there's an escalation in cost or utilization or both?
It's pretty maintained as far as cost, but the demand has continued. We don't see a big drop off on that. So this is, we had expected to end this year, and now if we're extending the full year, we need another 12 million based on our current spend and demand.
Could you explain again the reason for the extension?
Sure. And I
lost
may
that.
ask some others that are here. Yeah. So there was a third-party resource audit that was done last year. And as a result of it, a cross-functional team was formed to say, how do we address the observations of that audit, of which I do not know the details. But that group we've been meeting with, we actually met with them as we prepared to replace these contracts. And at one point, about fall last year, they said, you know, we could use, there's less risk in extending this for 1 year and allowing us to enhance and make mature the governance processes that we need to mitigate the risks of that third-party audit. So it was simply a request to allow a little more time on the current contracts to
Lisa,
maintain.
if I may.
Yeah.
So, Noel, so as part of this third-party audit findings, we put in place a cross-functional team really composed of internal strategy, SSM, legal. We all came together to come up with a plan around addressing the findings of this audit. Now, we put that plan in place, and that plan is requiring some time. We actually have put, according to the timetable that we've laid out, we're progressing appropriately. We've developed policy, and we've put in place some interim measures to assess any of the risk associated with that. Consequently, when Lisa came to present this contract, we said, hey, let's hold off rather than issue a new this contract. Let's wait in order so that our policy, the new contract, will be in line with our policy. So that's why there's been a delay, and that's why she's asking for this extension.
Eve,
And I will add, sorry.
one way of looking at this is, what was it, a 5-year contract for 55 million?
Mhm.
We got a pretty good
Yes.
deal on that, looking back and we're going to go for another year, and then I expect another 5-year contract. Prices have changed in the 5-year period, and that's what's reflected in the 12 million. Is that correct?
Correct. And we've actually allowed the prices to stay flat, so they're not increasing in that time.
Right, actually, the rates are actually very favorable
They are.
under the existing contract. If we were to do new today, the rates would be significantly higher than what we have under this contract.
Mhm.
So by doing this, we are maintaining lower rates.
For a year.
So is the
For half a
contract,
year.
is
Actually,
the
it's half a
contract,
year.
is the contract being extended for 6 months or for a year? It seems like it's 6 months for
So
12 months.
6 months, right?
Yeah.
Right, so it's
6 months
for-
now. There was a grace period extension to the end of the year, and so this is just the additional 6 months.
Okay.
I gotta admit, I'm a little bit confused, but
I'm a little
What-
confused too.
what third-party audit are we talking about, Eve?
It's an internal audit, yes.
Oh,
It was
internal
our
audit.
own internal audit. You heard Alex. Okay.
I thought you said third-party audit. I'm going, okay, so.
No, so
And
there
how
was
are
an
we
internal
going to
audit.
replace? So is there incremental cost to us from what we would have otherwise done? I'm confused on this alignment objective and what the incremental cost to us of what we would have done versus what we are doing. Can someone just address that for me? I realize you're asking for an extra 12 million here, but that's 12 million versus what would we have spent had we not wanted to
So-
align or
Similar.
whatever? I'm not fully grasping.
Yeah, Chairman, this is Rob. What the request is for us to, for the year period of time through mid next year, June of 2023, is to get the approval to be able to spend the $12 million. The $12 million have been budgeted to be able to support the project demand by each of the business units. So we're not asking for more money. We have it budgeted. It's really the approval to spend to get the resources to meet the demand from a resource perspective. So we're not asking for an increase, but the ability, and by the way, this is slightly less, but pretty much in line with the 5-year burn rate, if you will, or consumption rate, just because the project demand has increased. So our forecast, and we think it's very reasonable based on the portfolio, is $12 million. So again, we're not asking for more money. We did budget, each of the business units did budget the money. It's in the approved budget. We're just asking for the ability to get your approval to be able to spend against the contract and extend the contract to be able to get the resources to meet the project demand. Does that help?
And the alternative would have been to do what, Rob? That's on, what would the alternative have been? What were you going to do?
Right,
No,
to
we-
replace the contracts.
We would be issuing a new RFP
Right.
as we intended and had started. And we said, time out, let's make sure that we get the policies in place to allow us to then execute the RFP that reflects the policy changes that Eve was alluding to.
And so you think you got more favorable pricing on the extension than you would have gotten on the new contract?
Oh, yeah.
We believe
All-
absolutely that's true.
So let's just keep extending. It doesn't sound like we ever need a new contract.
Well,
It's a thought, right?
that's an option. We're just, oh, I'm sorry.
Or to finish the work so that you don't need an extension. Because my understand is what was explained is that you had to do this extension because you've had to adjust your plan based on the feedback you got from the audit. So you're trying to address any policy gaps or what have you. And you think that you'll be able to work through that. And these are consultants or advisors who are going to help you. That's, I think the word Eve was using, align those gaps that were found through the audit and the policies and procedures you're now putting in place.
Well, one has
Is that right?
nothing to do with the other. I mean, this is IT support, right? You just need more
Correct.
IT
These
support
contracts
across the organization.
Are, right.
It seems like we're commingling and making this a lot more complicated. You're just asking
Yeah,
for an
and that's
additional
what-
12 million bucks to extend the contract you have. And you're telling me
Correct.
that's what
So
you would have,
we're-
that's what you budgeted and we're planning to spend anyway.
That's correct.
Yes.
And so the audit really has, in my mind, nothing to do with this, other than you decided to just extend versus start a new RFP process based on whatever the audit tells you the RFP ought to include, right?
Yep,
You
that's
have it,
fair.
yep.
No. Well, it wasn't, the audit wasn't what told you what you needed for the RFP, right? The audit okay, I don't want to make it more complicated.
Well,
I guess I'm not sure what the audit was and why we were referencing the audit. I thought the audit was.
me either.
Well, so let me try to explain a little bit. So part of the audit was to make sure that we have a little bit more robust review of contract scopes of work up front before we actually go out with an RFP. So the new strategy that Eve's team is putting
Proposal
together
process, Tracy's
is
got
to
nothing to
do
do with
this.
this work.
Yeah. Okay.
Right. This work is mostly continuing services, so it's continuing projects in
Right.
support of that.
Okay. I think I have it now.
It was
Great.
just the process of extending that we need more time.
Okay. All right.
And to Tracy's point about completing work, I'm assuming this is, there's going to be ongoing work, right? I mean, this is just part of our
Absolutely.
MO. We outsource
Right.
IT services because as you said up front, we can't hire or it's not prudent or whatever, right?
Right. We will always
So
need
this isn't the
some
last 12
sort of
million we're
consulting.
going to spend. It's just, there's going to be a new contract for this go forward spending.
Or an
That is
extension.
correct.
Okay,
All right,
Well, maybe.
great.
all right, sorry.
If there are no other questions, Okay, I think we're all clear on this, so at least thanks. So I will now ask for a motion to recommend this item for the full board for adoption.
So moved.
Second.
Moved and seconded. All in favor, say aye.
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 Any opposed? Great, thanks. Motion carried. Thank you, Lisa. I think you've got the next item on the agenda as well.
I do.
Yeah.
Eva,
All
are you
right,
gonna
jump
say
right in.
Oh, sure.
Okay.
I wanted to provide a little bit of context for the 3 foundational pillar updates that the board is about to hear. We're in the second year of our Vision 2030 strategy, and that's a 10-year outlook. So today's material provides an update on what we've done, any outcomes that we've achieved, and also what we plan on doing for the remainder of 2022. Today, Lisa, Carrie, Jane, and Tom are going to just provide you quick highlights for the material that you've received. Yeah.
Right. So go next slide. So digitalization, one of the pillars of Vision 2030. While it's a new pillar, it's not new. We've been working on digitalization since we first had the goal to be the end-to-end digital utility in the country. So this is really an organizing slide. It shows you kind of how we're going to be addressing digitalization pillar going forward, how we're going to measure it, and how we're going to track our progress on it. If you want to go right to the next slide, as far as the Q1 update, the major significant accomplishment this year in Q1 was completing the first ever technology and innovation strategy and associated roadmaps. And what that's allowed us to do is strengthen that digitalization pillar and how we're organizing it with those 5 roadmaps, and they were shown on the previous page, and focus on our technology innovation. So we are really now setting the stage for how we're going to expand and scale our digital services. Our foundation is important. We need to make sure that we're secure, we're resilient, and we're efficient. We're going to be doing more with our digital capabilities, making sure that our businesses can have the data that they need to make have the information and make the decisions that they need going forward. And we're going to be expanding on technology and innovation and using some of our current investments like the Agile Lab. And where can we use that more with partners like NYSERDA? So bringing that strategy, it's really has organized us and focused us on those roadmaps and how we're going to be continuing for the next 8 years on this digitalization pillar. So if you jump to the next slide, there's just gives you a brief view of 2022 major deliverables, but it is, as I said, foundational. So expanding our cyber, we're utilizing our co-ops and munis to help us with our cyber defense. It improves their defense, which also in turn improves our defense. We're making a more modernized infrastructure, more cloud-based services, which are cheaper over time to run. We're also looking at simplifying the architecture. Again, simplification, less cost, less risk. Automation, it allows us less risk there too. So very much tied with some of the other pillars and priorities of Vision 2030. And finally, as I said, just continuing to look at what technology innovation is out there that we can apply new to the problems and solutions that we need at NYPA. Any questions?
Lisa, it's sort of a question, and after I read through this, what I ended up with, and maybe it's covered in another pillar or aspect of our Vision 2030, but when all of these items that seemed more internally focused on how we as an organization operate and are functioning in a technologically advanced way. And I was like, I was wondering, how is it that this translate, when you think about digitalization, how does this translate for the customer or access to the customer or value to the customer? Obviously operating internally more, in an automated fashion, in a more technology data-driven way is important, certainly, but is there an aspect of this application of delivery to the customer that's under this?
Yes,
this pillar?
It is, and actually that pillar B or tactic B that you see there is about our digital capabilities. So IT is an enabler, but if you take some of the work that we're doing with commercial ops, I'm making sure that they have the data that they can now provide and and give to the customers so that they can make their own choices on where they're looking at energy efficiency. So that's one area. Some of the billing work that we do, which again, foundational, but it supports our customers and making things easier. So we are working on several billing projects right now, making that bill that they see easier to understand. All of the CDEX work, the customer digital experience, and customer data management. Customer data management and data is key to that. If we don't have good quality data, then what they're using and to present out to the business and to make their decisions going forward would not happen. So it is, while it is enabling, it is very much making sure that those business initiated, customer focused initiatives are working as they should.
Okay. Thank you. There are no votes for
Mhm.
this. This is just an update.
Nope.
Any other questions for Lisa? Great. Okay. I think, Tom, you're up next on the resilience.
Thank you.
Trustees, it's Adrienne Lotto. I'll just offer a few brief opening comments and then turn it over to Tom Savin to update all of you on the resilience pillar. So similar to Lisa's comments on digitization, resilience is not new to NYPA. The program was stood up originally back in 2017, and we continue to make good progress today. The ever-changing business environment remains a risk driver, and it's important that NYPA stay ahead and continue to develop our resilience muscle. So we've seen, the change in frequency of storms, certainly things like, again, the risks experienced by Colonial Pipeline, the threat of ransomware, all provide risk drivers that highlight why the resilience program is so critical. So with that, I'll turn it over to Tom to just offer a few key highlights of what we've accomplished in this past year and where we're hoping to go. Tom?
Thank you, Adrienne. Good morning, Chairman Gibbon and trustees. I will be very brief with my remarks in the interest of time and just highlight the one milestone per slide. Next slide, please. So on Tactic A, we did complete the first of 3 tasks under the climate adaptation study, which includes the completion of climate projections for various climate scenarios across NYPA's footprint. That culminated in a presentation last month to internal stakeholders, plus EPRI and Columbia University, who are participating in a consortium to challenge and validate our work, as well as to identify potential blind spots. Going forward and through year end, we will continue to focus on maturing the business continuity program and also completing the climate adaptation study. Next slide, please. For Tactic B, a recent accomplishment includes the publishing of the board approved risk appetite statement, and we have commenced a communication campaign that's going to run through year end to engage personnel and really bring awareness to the risk appetite. Going forward and through year end, we will also continue other activities shown here to advance NYPA's risk maturity throughout the enterprise. Next slide, please. A few recent accomplishments for Tactic C is best summarized as completing key business requirements and technical design documents for system enhancements and new functionality that we're going to be implementing in the coming months. This includes updates supporting key risk indicators, risk controls, and audit integration, and completing the process library. Going forward and through year end, we will continue to make enhancements to established modules, but we're also going to build upon existing EGRC functionality as well as implement new functionality. Next slide. And on the metrics and outcomes, the key takeaway here is we are on track with all metrics, and we do not anticipate any issues that would prevent us from accomplishing these outcomes by year end. That concludes my remarks. I am happy to take any comments or questions.
What kind of feedback do you get from the employees in the field and putting all of this in place and utilizing it?
We've received very positive feedback from a business continuity perspective. Given today's climate, everyone is aware of the need and the importance of business continuity, and everyone has been making a contribution. As it relates to the climate adaptation study, we are going to be conducting region-based interviews in May and June with operations, planning, engineering folks to get into a bit more detail on the climate projections, but also to understand location-specific climate and infrastructure hazards and risks that we should be pulling into the test to analysis. So that's going to come in due time, but up until this point, both White Plains and operating sites have been very accommodating and have been leaning in.
Great. Thanks, Tom. No votes is needed on this either. Carrie Jane, you're gonna walk us through our ESG update.
I'll try and be brief as well. So for ESG, we have 3 tactics to deliver on our vision, and these are reporting, lead by example programs, and integration of ESG into policies, processes, and culture. And we're off to a good start and moving work forward on all 3. Next slide, please. As I'm sure you're aware, there's an increased focus on ESG reporting, especially climate reporting with the proposed SEC ruling on climate risk disclosure. And we are ramping up our reporting efforts. We have several reporting efforts underway. We're currently preparing the 2021 sustainability report, which will be built around the 15 material issues identified in our 2020 materiality assessment, and will align with GRI, SASB, and TCFD as did the 2020 report. We're also laying the foundation for annual integrated reporting, with our first report to be issued next year. And like the sustainability report, that report will align with GRI, SASB, TCFD, as well as CDP. That report will be audited and third-party assured, and we're aiming for limited assurance. We've identified 180 metrics to be included, most of which are from the standards, but some of which are company metrics, which we've selected to help tell our value creation story. This is obviously a big endeavor, and data quality is critical. So we've begun a process to assess controls for all the metrics and enhance the controls. And this is in partnership with the internal business controls group and data owners. So we're engaging data owners across the enterprise to map data processes and enhance the controls. Our goal is to test the controls this fall, so we're ready for reporting starting in January. This is a big effort for the company, but it's a really critical effort because to ensure data quality. And I wanted to iterate that we're expecting annual reporting to be an iterative process with continual improvement across years. And that applies both to disclosures and also to data controls. In addition to the 2 reporting efforts, we're expanding greenhouse gas accounting to include indirect emissions from various sources, such as purchased electricity, transmission line losses, and electricity purchases for resale. And this will help us identify opportunities for further reducing our carbon footprint and also more fully reporting on climate. And we've also committed to becoming an early adopter of the CDP Public Authorities Climate Risk Questionnaire, and have been asked by the state to lead coordination of that effort with other utilities. Next slide, please. Regarding Tactic B, our ESG strategy is built around the 15 material topics identified in our assessment. But the sustainability group and the sustainability group provides guidance on all of these and shares best industry practices. But we focus directly on projects that support the state goals, such as climate mitigation and adaptation. Tom mentioned the climate resilience study, and we are collaborating with risk on that. And the next step, which we will be coordinating, is developing a strategy to operationalize the findings. This will include identifying key tasks, such as specifications for design, incremental projects to adapt existing assets, and identification of operational measures. So that's already in the works, so that we're ready to move ahead once the report is completed in October. A couple of other efforts include our energy master plan for neighboring canals to identify energy efficiency and electrification opportunities, and also our EV infrastructure assessment for all sites. Next slide, please. Other programs include land supply chain and waste. For the sake of time, I won't go into all of them, but I did want to mention our land program. We're evaluating land management practices and assessing the potential for increasing natural carbon storage, biodiversity, and climate resilience. So this is really complementary. It's a complementary project with the Argonne study, which focuses on assets. We're looking at surrounding lands to see how any management of those lands can also support our resilience overall. And we're also in other land efforts, creating pollinator gardens and meadows, which is really a great engagement opportunity, and partnering with commercial operations to expand the tree power program. Last slide, please. The last tactic C, is really about embedding ESG considerations in decision making. And this is really critical for our success. So we reconvened the Sustainability Advisory Council, which is made up of heads of over 30 departments. And engaging these department heads is critical because they're responsible for achieving sustainability goals that fall under their purview. We worked with them to develop 2022 action plans for 55 goals identified in the sustainability plan, and we're tracking progress on those goals through the year. We're also reviewing and revising relevant policies. And lastly, we are wrapping up our training on climate science this quarter. And we've seen a significant increase in climate literacy. So I would say the program overall has been a success. Last slide, please. On metrics, just as with disclosures and controls, we're going to be adding to and refining metrics as programs evolve. I'm not sure if you had any questions about these specific metrics. For example, Build Smart, doesn't indicate progress this year, but that's because big projects are being implemented right now that reached 30% design last year. For fleet, we're moving ahead well with infrastructure. On the vehicle procurement side, there are challenges due to lack of availability of appropriate vehicles and supply chain issues. On habitat restoration, you'll see that the baseline is 0. We're resetting every year because our aggregated total is so vast that we would lose a clear view into annual progress. And just to last note, we're adding new metrics next year for greenhouse gas emissions on vehicle fleet and buildings, as well as water efficiency. Thank you.
And just also to add to that, what Carrie Jane is saying in terms of this whole program, just in terms of relevance or recent events, we had a meeting yesterday with Moody's, and they are incorporating ESG into their ratings of all utilities, both public and private. They're going to come out with a scorecard, I believe, at the end of May. And we're going back and forth with them on some of the specifics. But from what we can tell now, we're going to come out looking really well in terms of where we sit in that universe. We'll probably be in the top 10% of all the rated entities in terms of our ESG program, with room for improvement, of course. But I think it's a good place for us to start. And I think they appreciate the framework and everything that we've built around our program to date, and view us as being ahead of others in this area. But thank you, Carrie Jane.
Yeah, I appreciate that, Adam. And obviously it's not just utilities that they're looking at this ESG. And Carrie Jane, you've done some great work here in terms of positioning our story around efforts and laying the framework for the entire organization to be guided by. One question that I had is, we label this ESG. It is and I realize there are overlaps. So what I'm about to say next, may not entirely be fair because there is this overlap. But we seem to be very heavy in the E of the ESG. I don't know. Is there another place where you will cover like the S part, which is usually around, and maybe we decided to carve that out. When you're talking about talent and working with the communities and things of that governance, I can certainly understand that. It's about the leadership structure of the organization. Again, we use this big label for us as ESG, but the discussion today was more heavily weighted toward the E than the other 3 letters of that. And again, recognizing there is some overlap in some of those areas.
Yeah, that is such a good point. And we work very closely with departments across the all 15 material topics, which do include social and governance, and especially through the Sustainability Advisory Council and through reporting provides a framework for us to really influence performance in those areas. I think the reason that this presentation seems to focus on environmental is because we have a very hands-on approach on sustainability programs that tie to state goals. We're responsible for state reporting on climate and also for delivering on EV electrification goals, building efficiency, build smart. We manage the Build Smart program. We manage the infrastructure side of our EV fleet electrification. And so we really kind of wear 2 hats. We wear the old hat of being the sustainability team that reports to the state and makes sure we meet our goals. And then this broader expanded role of advising across the organization on ESG and ESG strategy, best industry practices, reporting requirements. And I love the expanded scope. I find it so interesting. And I think our challenge is that broader engagement and making sure we have the influence that we should be having across the S and the G.
If the board would like, we could come back with a more targeted presentation on the S and the G at a future meeting if you'd like.
I just think if we're going to
also
say
like to
we've got an
note that-
ESG framework, we need to, or otherwise we just need to call it the E framework. So.
Right.
Yeah. We also have a foundational pillar, DE&I, that we also update the board on separately. So that has dimensions of the social, and then you have a separate governance committee. So this is 3 of the 5 foundational pillars, and we'll continue to update the board.
My general question / comment, so the good news is this shows that we're on track to achieve the designated targets that were established at some prior point in time based on what we then knew or the world in which we were then operating. Help me with the relevance of some type of refresh to ensure the path we're on is still, I won't say appropriate, but the pace at which we're moving in certain areas is relevant, or how we need to move with more pace or adapt or adjust, as opposed to, well, we're all green and we're hitting our historically established targets, but in terms of what the market expects, what our customers need, what the world in general, where we now find ourselves is different in many ways than it was 2 or 3 years ago when we started down this path. Help me with, how we ensure we're optimizing, let alone maximizing our potential here.
That's a good question. So there are 2 ways in which that we specifically have ensure that we stay relevant, right? Because that's at the end of the day, the question that you're asking.
Right.
The first is procedurally, from a process standpoint. Every month we review with the tactic leads sort of their progress against plan. And we also have updates around sort of where the essentially the trends that are going on in the market and bringing back those trends within those update meetings. Additionally, we have these foundational pillars every 6 months where we talk to the trustees and get your thoughts and comments on our progress to date. So that's another way we fold in the external market into our processes. And then finally, within our Vision 2030, we establish outcomes or 10-year targets that we're trying to meet. Every year we create an implementation plan, which actually is like an annual calibration that says, hey, based on the information that we've learned, how are we progressing? How are we supposed to progress this year in order to reach that ultimate outcome? That's how we ensure that, one, every month we're on track meeting the outcomes and we're bringing in new information. And every year we take a moment to pause and look back and say, hey, is there a new plan that needs to be put in place?
All right, well, we would benefit. Let's figure out a way to ensure that as a board, we have the benefit of that top-down look, Yves, at some point during the year. So we know where you've identified the need to refocus, tweak, revise, accelerate, drop some of the initiatives. Obviously, no long-term plan, can be relevant for its intended duration, given the dynamic environment we operate in. So, I said, derive some comfort from the fact that we're on schedule. On the other hand, I always like to start at the top and make sure the plan is still as relevant and appropriately paced as possible. So think about how we can best have that conversation. All right.
Will do.
Thank you.
Great, thanks. If there are no other questions, there's no vote needed for Carrie Jane's discussion. The committee members have the consent agenda before them, and it's now before the full committee for adoption. I'll ask for a motion to adopt the consent agenda.
So moved.
Second.
Second.
Moved and seconded.
Oh, sorry.
All in favor, say aye.
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 Any opposed? Great, motion carries. The date of the next Joint Finance and Risk Committee meeting is scheduled for July 14th. I'll ask for a motion to close the meeting.
So moved.
Can I get a second?
Second.
All in favor, say aye.
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 Any opposed? Motion carries. Thank you, everyone. Thank you, team. Good
Thank you.
work.
Thank you.
Stay
Thanks
healthy.
very much, Tracy. Thanks, everyone.